Happy Saturday, everybody. Guys, the NAR is training realtors to lie about a specific topic. We're going to get into that topic. I'm also going to show you a neighborhood in Nashville I believe is poised for a drop. I'm going to show you why and look at some of the metrics there. And it's not sales comps, guys. You can't look at sales comps to see some of the red flags out there. And then I have a tweet going viral. I can't believe it. So I'm going to show you that tweet. There's so much to cover. But first, my name is Ethan Flynn. I'm a CPA, a realtor. I'm not trying to get anybody to buy in this market, but if you are planning to buy and you're in the Williamson County, Franklin, Cool Springs, Brentwood area, and you are a cash-heavy buyer, please reach out. I'd love to help you. So without further ado, let's get into the article that I'm about to lose my mind on. Buy now, refi later. I was in a training the other day, and this was the mantra: buy now, refi later. Now, 84% of recent homebuyers plan on refinancing. Now, this is the quote that I want you to see, because it's just an absolute, it's just so deceptive and predatory. Most recent homebuyers, 82%, were assured they could buy now and refinance later. They most often heard this from their mortgage loan officer and then their real estate agent, 63% and 60%. So well over half of both mortgage loan officers and realtors are perpetuating this lie. It's completely false. And here's how predatory it is. 13% say they won't be able to keep making payments if they can't refinance. Guys, when I was in that training, there was such certainty that mortgage rates would go down that they could not fathom that what I was saying was true, okay? And all I said was, you can't predict mortgage rates, okay? That's all I said. But they just couldn't fathom, and because I talked to the broker afterwards and I said, you have a reputational risk here, and you also are putting people in financial positions that could be very bad. And of course, you can see here, 13%, according to the survey, are in financial positions. They're being told a lie, and they're putting themselves in. I mean, this is like life-saving stuff. You ask me why I'm saying I'm working with cash-heavy buyers and cash buyers right now, and I'm not helping people that are scraping together money. It's because this market doesn't make sense, and people are putting themselves in financial situations that will literally ruin their life savings. And to be honest with you, if it's not you, but you're scraping your money together, you're probably moving into a neighborhood where your neighbor is. And I just can't stomach that right now. If you're a cash buyer and you have to put your cash somewhere, Tennessee is a great place to put your cash. The returns still don't make sense from a financial perspective. You can still buy treasuries. But if you're going to live somewhere anyway, buy cash. And it's a good place to store wealth. That's all I'll say. I'm not going to say you're going to get the highest return. Treasuries make way more sense right now. But Tennessee long term, I mean, I'm telling you, there are 323 million people that don't live in Tennessee, that live in the United States of America. And let me tell you, when they Google where should they move to out of state, Tennessee is making the top of their list, okay? It's making their top of the list for a ton of reasons. It's not a bad place to buy if you have cash, but if you're borrowing, there's something called negative leverage. You don't want negative leverage. Negative leverage is where you would literally, if you rented it out, you would lose money. Your return would be lower renting it out than if you didn't borrow at all. It just doesn't make sense. Okay, let's keep going. Lawrence Union, the Federal Reserve paused today, September 20th. It's the right decision to collect more data. Mortgage rates, therefore, are essentially at their peak and set to decline as we head into next year. Good for home prices. Guys, this is manipulative and deceptive rhetoric. He has no idea whether or not mortgage rates are going down. He's assuming they're going down because typically in the past, when Fed pauses and even drops rates, mortgage rates go down. However, when you go back to the 70s in an inflationary environment and you do this, you can actually trigger 10-year and 30-year bond sell-offs. And that's exactly what happened after the Fed paused. We had one of the biggest sell-offs in bonds. Mortgage rates shot up the day after they announced the pause. Okay, so this guy, he's not telling you the truth. He has no idea. And I think he's intentionally, I just think it's intentionally deceptive. And I hate to say that, but I think he's way too smart to believe what he's saying. And so let's break this apart piece by piece. Okay, the orange line is demand here in Nashville, and the blue dots are interest rates. So last year, one of the premises of buy now, refinance later is that if you don't buy now, you won't have a chance to buy later when rates drop because everybody will stampede in. But in fact, that's false. What we can see from the last year is that every time rates dropped, it coincided with demand dropping. Now, I think this is two reasons for this. One is there was a massive amount of fear in the economy and people stopped buying. But another reason is that if rates are dropping, wouldn't you want to wait and see kind of where they land? If they're in a consistent downtrend, you kind of want to wait. And that's exactly what happened. Notice here, when rates troughed and they started going back up, what happened to demand? It stabilized. Okay. And again, as rates dropped, demand was dropping. And again, as rates stabilized, demand stabilized. And as it went up, that's when demand picked up. Okay. So the idea that you're going to miss out is just plain false. But why do people even say rates are going to drop? Well, one tool that realtors use, I'm going to show you, this is Fannie Mae's forecast. They'll pull out the Fannie Mae forecast and they'll say, well, look, Fannie Mae's forecasting the 30-year fixed rate mortgage. It's going to peak this year and then drop all next year. Nice little drop. Thank you, Fannie Mae, for this piece of paper that so many economists worked so hard on getting this nice little slide down in mortgage rates for next year. Now, the irony of this is, let's look at what they did last time. Here's August of 22, 30-year fixed rate. Oh, wait a minute. 1 year ago, they forecasted 2023 in the fours. Did we see anything even close to the fours this year? No, we did not. In fact, they were 50 to almost 100% wrong on their 30-year fixed rate mortgage forecast for this year. So whenever somebody says, well, the experts are telling me that mortgage rates are going to drop, you can say, well, what did the experts tell you last year? They told you mortgage rates are going to drop. And they told you to buy ARMs and 2-1 buy downs because there's no fathomable way that we would be in a 7% mortgage rate environment all year. And here we are. Guys, I don't know where mortgage rates are going to be. Okay? I don't know. We could be in a recession and they could tank. We could be in a recession and they could go up. Okay? We could be going up for the rest of the year. I don't know. I think that there is a very significant chance that mortgage rates will continue to go up, and it has much more to do with a macro environment that goes way over my head. But when I listen to people like Larry Summers and Jamie Dimon, and I look at the national debt and the deficit, the stuff doesn't add up. In fact, let's go back to the 70s really quick. The last time we had an inflationary environment, what happened with mortgage rates? Okay, we see it goes back to 1971. You can see we were in an uptrend. And look at this. We went from 898 all the way up to 10 by 1978. Now, 10 and a half. Okay, so if we went uptrend like that and people are like, oh, mortgage rates are going to come down, you should refi. What happened? It went up again. It just kept going up. In fact, it went up again and again and again. And for 3 years, it was straight up. It didn't drop for 3 years. And then it shot up and then shot back down. Okay, so my point is, we just don't know. Okay, we're in an inflationary environment. It's probably going to look much more like this crazy upward trajectory than it is like the last 40 years where it dropped for 40 straight years. Okay, we're in a deleveraging cycle, inflationary cycle. The Fed is going to have to print. They're not going to be able to hold things down without more printing. They're just not. It's going to get weird. If you think about it, it's not just commercial real estate. It's corporate bonds. It's everything. Do not bank on mortgage rates dropping. And if you hear this lie, you can just just ask. If they say, well, Fannie Mae's forecast, just ask them, well, what did they forecast last year? Okay. Nobody knows. Nobody knows where it's going. Nobody knows where it's going. Okay. I want to show you this neighborhood. This neighborhood right here, you can see the comps. 900s, a million. Attractive neighborhood, guys. It's attractive neighborhood. Why are there red flags all over this neighborhood? Well, I'll show you. Actually, you know what? Let's go back to the map. I'm going to show you. I'm going to pull just actives just for a minute here. Look at this. Okay, this is just the actives. Look how long they've been on the market, guys. 14 days is the lowest. They've been on the market 120 days. We've got over half of them have been on the market more than 60 days. Okay, the one under contract has been on the market 60 days. Now that may not seem like a long time. And in history, some people say it's totally fine to be on the market for 60 days. But there are other ways that we can value the market. And this is what I want you to see. Okay, if we go back to that search and we see what's closed in the last year, but instead of looking at sales comps, let's see if we can get rentals. Let's see if we've got a rental that's closed in the last year. And what you'll see one. It's right here. It's a beautiful house, $34.50. It rented for $44.50 a month. That's about $1.30 a square foot. Now, I'm oversimplifying here, but I think this generally will work. Okay, so if we took $1.30 a square foot and we go back to our listings here that are for sale, 3123 times 1.3, we get about $4,000 a month. Okay, now I'm going to oversimplify this, This is a high level math exercise. You can do this in any neighborhood. So 4,000 a month, we're going to multiply that by 12. We get 48,718. Okay, I'm going to assume, let's see here, a 10% management fee, 8% vacancy, 5% maintenance. What is that, like 23%? Let's just assume it's only 80%. Let's assume you're like self-managing it. So it's really only like an 80%, 20% expense ratio. Here's the problem with this. 38,975 would be your net operating income over 949. Guys, that's a 4% return on your money. 4%. Okay, now these houses are sitting. People are buying elsewhere. They're not choosing to buy these houses. We know that the rental comp suggests that you're really only getting a 4% return. And we also know you can buy treasuries for 30 years and get a higher return than that. You could buy treasuries on the low end and get a higher at 5.5%. Are rents going up right now? They're not going up right now. Could they go up next year? Absolutely, they could. And so, you would have to speculate the rents would go up. But here's the other problem with this. Why would you buy a house that gets a 4% return and borrow money for 7%? This is called negative leverage. It's where you get a smaller return if you actually borrow. Instead of it levering up your returns, you are lowering your returns or even creating losses. This makes cash buying make sense because you can actually get a return, but it makes leveraging or borrowing not make sense. This is why I'm saying I'm only working with cash heavy buyers right now. It's not because I want to harm or hurt or I don't want to help people that don't have a lot of cash. It just doesn't make sense. Almost every neighborhood I look at, it doesn't make sense to buy if you're not putting down heavy amounts of cash. Now, there's what? 323 million people in the United States of America that don't live in Tennessee. I guarantee you, every one of them searching out of state is going to put Tennessee on the top of their list. They may not pick Tennessee, but it's a hot place. Okay. My point is that's a lot of people that can move here. Prices can still go up, but we can't plan on that when there's negative leverage. You really ought to be careful about buying in those situations. Last thing I want to show you, I have a tweet that's going viral. Guys, I'll do a video on this. Basically, the tweet, Nashville's luxury apartment, alcove, and sister building prime, 700 units, have a $186 million construction loan. Now, if I'm being totally transparent, I don't understand the mechanics of construction loans on big buildings like this. So I just asked, I said, I'm just going to do the simple math here. That's roughly $1,800 a month per unit in interest expense if you take 186 million and you multiply it by 8%. Okay, so the interest expense would just absolutely drown these units. So I just asked and apparently went viral. I'm fairly new to the Twitter game, so this was kind of, exciting, overwhelming, whatever you want to say. Yeah, 60,000 people viewed this. Whoa. If you do like these videos, please click like and share it with a realtor who's telling you to buy now and refinance later. And with that, I hope you guys have a great weekend. Thanks.